Good morning, everyone. Welcome to our webinar. Today, we're going to be talking about the Secure Act, new law that went into effect on January 1st of 2020, how it impacts you, what are some of the planning opportunities with regard to the new law, and what are some of the pitfalls that you should be thinking about making sure that you avoid. And this legislation came in as part of the budget reconciliation. So although it had been discussed in the House and passed the House last June, it had been tracked and followed since then. It had been stuck in the Senate until we needed to fund the government, and it then got tacked on to the budget bill. So it came upon us in a relatively short period of time, and now everyone is trying to sort out what the provisions of the Secure Act mean to each of us. So in looking at our Secure Act today, it is HR 1944, and it amends the Internal Revenue Code. So as with all Internal Revenue Code changes, it's a tax law. It changes first statutorily, and then it filters down through regulations. So one of the themes that you're going to hear today is that we have the statute, so we know what we know. We don't have the regulations, so in a way, we know what we don't know, but what we're going to find throughout the impact of the Secure Act is there are still a lot, and we don't know what we don't know. So we will try to project and predict things like tax law changes, which will severely impact how the Secure Act impacts you. And with that, why don't we get started and take a look at how the Secure Act operates. And this is an example of the new 10-year rule. So you'll see that there are several variables here. And we start with the beneficiaries because the beneficiary's age is important at age 40 and a $1 million IRA account. We're going to assume pre-tax growth of 6%, and we're going to assume that the after-tax growth rate is 4.75%. So remember, in our illustrations, we're going to have money accumulating inside of an IRA and money that's paid out accumulating outside of an IRA. Inside the IRA, it's full tax deferral. Outside the IRA is where we're going to talk about the important tax consequences of the withdrawals and now the mandatory 10-year rule. So again, the variables that are in the math of the Secure Act are many. And when we look at the variables, it's not only the current age of the participant, the value of the account, the growth rate in the account, but what's going to be one of the key fundamentals and the metrics that we're going to have to try to measure and weigh out. This is one of the unknowns. What will be the tax rate of the beneficiary at the time the money comes out of the tax qualified account? So as people defer money into a traditional IRA, you know that you don't pay tax on that dollar going in. The dollar grows tax deferred, and when you pull it out, whether it's $1 or $2 or $3, you pay tax on the entire amount coming out of the IRA. And so we have projected tax rates here of 24% if we use the life expectancy rule and 28% if we use the 10-year rule. And we're going to amortize this over the 10 years. So a couple of concepts here to break this all down. And these numbers are important. When we're looking at the IRA, we have certain critical dates. So we have a required beginning date when you must start drawing from your IRA. That has actually gone from 70 and a half to 72. There are still some technical issues with how that is going to play out for people who are in that range now. But basically now, the rule is that you can defer taking from your retirement account until age 72. You can also continue contributing to your account if you are working, because only earned income goes into the IRA. And you can contribute to the IRA beyond age 70 rather, as long as you're working and earning income. So those are two of the positives. Two things that changed in the statute seen as good. One is extending the required beginning date to 72. The other, allowing contributions beyond age 70. What we're going to focus on is this 10-year rule now. And we're going to look at the after-tax results. Remember, under the old rules, under the old Internal Revenue Code section, a beneficiary could stretch the IRA over their life expectancy. And by stretching it over their life expectancy, they're able to keep those dollars earning within the tax-deferred account and draw out only the amounts that are required based upon their life expectancy. With certain exceptions, that rule is gone. So the stretch IRA, the ability to defer that tax and continue to take money out over time, is one of the things the government eliminated with the Secure Act. And does that make you feel secure? Doesn't make me feel secure, but this is where the government is trying to get paid. They have a budget deficit. Taxes and deficits drive a lot of legislation and policy, and it drove the Secure Act. They want to get their money sooner. So you'll see the chart here, and it compares the deferral of the IRA through the old rules and a life expectancy table, and it compares it to the deferral for 10 years, where over that 10-year time period, you take equal payments over 10 years, and you can see the green shaded box is going to be larger in all cases. And when it gets out to 40 years, you can see that it is a substantial loss by having to pull the money out and again pay tax on any reinvested funds from the IRA over that 10-year time period. So a lot of what we're going to talk about today is navigating these rules, creating beneficiary designations that will still allow you to minimize the tax burden on your beneficiary, but also looking at how we can, during lifetime, do some planning to enhance our ability to use those tax-deferred dollars that we've built up in our IRA, either convert them to tax-free dollars through a Roth conversion, using charitable trusts, and we're going to see some of the other techniques that we can experiment with. So the other thing we're going to talk in depth about is whether trusts can be a beneficiary now under the Secure Act, and the answer is yes, they can. Can we keep a trust as a designated beneficiary, which qualifies for the 10-year stretch as opposed to what was the 5-year rule? And the answer is yes, we can. And it also adds a definition, which we're going to talk about, of an eligible designated beneficiary, with certain classes of beneficiary that allow us to continue the stretch. So these are some of the exception rules. Trusts as beneficiary can be done provided you structure it properly, just like under the old rules. And the question becomes, how do we build trusts now to be the beneficiary of our retirement account and have the beneficiary then qualify as a designated beneficiary, maximizing the stretch, and for those eligible designated beneficiaries, continuing the lifetime stretch. So this is how we used to draft. We used to draft the Conduit trust. And the Conduit trust is something that we used to pour through the required distributions. And when a beneficiary inherits, if it's a Conduit trust, it's a safe harbor. It qualifies as that designated beneficiary, and we know it's going to be a good trust for the benefit of that individual. The problem is, now when we look at this Conduit trust and we see that we have a withdrawal, and here's a chart that helps us out. Look at the age of the beneficiary. Here we have a beneficiary age 30. If they used a life expectancy table of $1 million IRA, they would have to draw out only $18,762. That would be their required minimum distribution. What happens to the rest of the money if they're only taking out $18,000? It continues to grow tax deferred. Under the 10-year rule, they have the option of either taking it out all in 1 year, as a lot of beneficiaries do, and that's why we put it in trust, because You know, that $1 million could buy a Maserati, travel around the world, do a lot of things, but they're going to lose a significant amount in income tax. Well, now the government has forced us to take that money out. We can amortize it over 10 years to try to, again, get that lower tax bracket for the beneficiary. And if we amortize it over 10 years, then we have $142,378 coming out. And if we simply leave it invested at that rate of return, 6%, at the end of the 10 years, we would have just shy of $2 million. So this illustrates how these new rules are going to force the money out of the IRA. And if you look, that 6% rate of return is growing that IRA for the beneficiary with a life expectancy table all the way through the 10-year period. They're only taking out $37,000. At the end of the 10 years, under the life expectancy table, everything else that's returning off that 6% is continuing to grow inside of the inherited IRA. So the Secure Act has options for withdrawal, but for most beneficiaries, it only is the option of taking a lump sum or amortizing over the 10-year period. And we're going to be doing a lot of examining of beneficiary tax brackets. What is the beneficiary's income tax bracket? Something you have to know in order to now plan for your retirement account. So what is the big tax for an IRA? It's income tax. And we're talking today mostly about the income tax, but I want to give you just a little bit of a highlight of where the estate and gift taxes are today. And this is one of the we don't know what we don't know scenarios. So for federal estate and gift tax purposes, there is currently an $11,580,000 exemption per person. So for a married couple, that means you can pass roughly $23 million free of federal estate tax. That also applies to gift tax. So each of you today who's single can take out your checkbook and write a check for $11,580,000. And that does not have any federal estate tax or gift tax, because it's a current gift, payable. It's a taxable gift, but the exemption reduces the tax to zero. That is a part of the temporary tax cuts that apply to individuals that were enacted just a couple of years ago. The income tax rates, which we'll talk about in a bit, were another part of that same tax cut. So when we look at the tax cut, we look at the federal estate tax, the exemption is going to go from 11.58 million down to roughly 5 million adjusted for inflation at the end of 2025. And when we look at 2025, it isn't that far away. So when we're doing our planning, we want to make sure that we're looking at the estate tax, the changes in the federal estate tax law, and the ability to do the estate tax planning in conjunction with income tax planning. Where it becomes relevant in today's conversation is if you're an individual, we've always had challenges planning for individuals who are subject to the estate tax and also have the IRAs, 401ks, and income tax exposure. And in many cases, you ended up double taxed, because if you have to pull money out of an IRA, you do it in such a way that you have to then pay tax. And if you're pulling it out to pay estate tax, you're then on top of that paying income tax. Those rules are still there. So for any of you who are subject to federal estate taxes, and again, that's 11.58 million today, but in 5 years that goes down to 5 million. And we have an election, you might have heard, coming up in November. There'll be a lot of talk about that. And what we expect, if there is a Democratic candidate who wins, is that they will propose to accelerate the reductions in the estate tax exemption. Several of the candidates have proposals to reduce it to 3.5 million for estate tax federally and 1 million for gift tax. Don't know if that's going to happen. That's one of the unknowns. But we can expect, and most of the people who do the prognosticating in the tax area expect that at some point tax rates will go back up and estate tax exemptions will come back down. And the deficit is the fuel for that. If we could balance the budget, that may not be necessary, but right now we're still running at about a $1 trillion federal deficit. So this comes into the prognostication. Where's our crystal ball telling us this is going to go? Tax rates, income tax likely to go up, federal estate tax exemptions likely to come down. So when we're planning for our IRA and the accumulation and the distribution to our beneficiaries, all of that factors into the math and the predictions of where our tax rates will be at the appropriate time. In New York, we have taxes that are on top of the federal system. If you're listening from New Jersey, you don't. They don't have any federal estate or gift tax. They don't have any state estate or gift tax. They have the federal $11.5 million, $58 million exemption. Most states have repealed or eliminated or somehow matched their exemption to the federal. In New York, our exemption this year for 2020 is $5,850,000. So even though your state may be tax-free for federal, it may not for state. So we have to factor in the New York state estate tax into our math when we're looking at IRAs and integrating the IRA into an overall comprehensive estate plan. In New York, you should know there is no gift tax. So we have an ability to gift money in New York and have it pass tax-free. And within 3 years, if we die, it comes back in. But after 3 years, that gift in New York is outside of the tax system. So we have to keep the estate and gift tax picture in New York federally in mind. But now let's turn back to our IRA. Managing the income tax consequences, the solutions that are being discussed and that are now available under the new Secure Act 10-year rule. So I mentioned earlier that there are certain beneficiaries that are not impacted or have been given exceptions to this 10-year rule. The surviving spouse is an exempt individual. So when you leave your assets, your retirement assets to a surviving spouse, they still have the full capability to roll that account over into their own IRA. So the rollover, the spousal rollover, is still there. For many people, that's still going to be the most effective. But we're going to talk about a situation where perhaps you're accumulating too much in that IRA and it will come out over a very short 10-year period at the end, which will subject it to much higher income taxes. So spousal rollovers are available, but may not be the best course to follow in naming a spouse as the beneficiary. In addition, children under the age of 18 can still utilize the stretch. So a child who's 10 can inherit an IRA, use their life expectancy. So you would have very, very small, minimal annual distributions. And at the end of the 8 years till they turn 18, it's only those life expectancy required distributions that have to come out. At age 18, however, the account is going to begin the 10-year rule. So at age 18, that child would have to make an election to either take it out over an amortized 10-year period, so take equal payments over 10 years, or to take some other method of distribution, including deferring the account. So they could defer it the whole 10 years, allow it to grow, and then take it all out at age 28. So 10-year can be done on the 10-year rule, stretched up until age 18. We also have disabled beneficiaries. And there are statutes, but there are regulations that need to be written. So if a person qualifies as being disabled, generally that's using the Social Security definition of disability, which is an employability standard. If you are unable to sustain full-time gainful employment, then you can be determined to be disabled. And if you are a disabled individual under the new Secure Act, you're still going to be given the opportunity to stretch the IRA over your life expectancy. So this gives us opportunities, and we can draft trusts for people with disabilities that are called special needs trusts. And I mentioned earlier that a trust by definition cannot be a beneficiary. but the underlying beneficiary can. So when you create a trust properly, it's a see-through trust, and the account, the IRS, will look through the trust document to the actual beneficiary. So a properly structured special needs trust can get you the opportunity to stretch over that beneficiary's life expectancy. And that's a very good thing, planning for people with disabilities, because we can maintain the stretch, we can maintain the special needs trust that will keep them eligible for SSI, Medicaid, and other government entitlements. And so we have a planning opportunity here. There is also in the statute, but I wouldn't give you a definitive answer on this until the regulations come out. There is language to say that a trust with multiple beneficiaries, one of whom has a disability, can benefit from the disabled child's stretch, even though it's also going to be payable to the other children under that trust. So you can have a multi-beneficiary trust, one child with a disability, and it will come out theoretically under the oldest child's life expectancy, but it will come into this trust that's a special needs trust with multiple beneficiaries and could then be dispersed. It just changes the timing of the distribution for all of the beneficiaries based upon the disability of the disabled child. So we're not going to be aggressively drafting that until we have regs to clarify the opinion, but that's what it looks like for now. So there may be a significant planning opportunity in the special needs planning area for children with disabilities. There's also an exception for chronically disabled or chronically ill beneficiaries. And this definition goes over to long-term care. So if you are looking at long-term care, there's a trigger to generate a benefit under a long-term care insurance policy, and that is 2 out of 6 activities of daily living or a cognitive impairment. So if your beneficiary has a chronic illness and meets the definition of disabled or chronically ill under the long-term care insurance statute, then they would be eligible for the stretch over a life expectancy. So people with chronic illnesses, hard to predict that. People with disabilities that are disabled at the point in time of creation of the beneficiary designation, a little bit easier. But how do you draft? How do you draft your trusts now to accommodate all of these situations where potentially beneficiaries could be eligible for the stretch and avoid the 10-year rule if they have disability or chronic illness? And that's going to require us to do some contingency planning. Later in the program, we're going to talk a little bit about drafting the trusts and how those trust terms can be put in place so that you can keep flexibility in your document, that you can take advantage of the various exceptions to the 10-year rule that would allow your beneficiary to stretch, even if you don't know that that beneficiary has a disability or chronic illness at the time you create the plan. So drafting for contingencies has become very, very important. And the last exception, if the beneficiary is less than 10 years younger. So it's not a child, typically, but it could be, for example, if you have a couple and they're not married, and one spouse is less than 10 years younger, they could name the other person. That person wouldn't be entitled to a spousal rollover, but they would be entitled to stretch the IRA over their life expectancy. So someone less than 10 years, you can get the stretch for that individual. So those are the exceptions to the Secure Act. Now let's talk about some of the potential solutions to this 10-year rule. Obviously, the holy grail in IRA planning has always been to maximize tax deferral. There are some tools that we're going to talk about that allow us to replace the lifetime stretch with another vehicle that gives us an opportunity to go beyond the 10-year rule and to still use the life expectancy of the beneficiary. So we're going to talk about specific types of trusts that allow that. Bracket management. And this is the hardest part for me, because now we're not only looking at the tax bracket of the participant in the retirement plan. So if you have a 401k or an IRA, your life expectancy is going to be the guidepost. So when you hit your required beginning date now at age 72, you're going to begin withdrawals using a table based upon that 72-year-old age, and a joint table, which is the current standard table that you take it out over. So that determines how you take it out. What about your beneficiaries? And in most cases, this is going to be the children. We may do a spousal rollover, we may not. But if your children are all exceptionally high earners and they are currently in the maximum income tax bracket, and you have every reason to believe that in 10 years, 20 years, they're going to stay in that higher income tax bracket, then early withdrawals may be in order. And there is a trust we're going to mention that you can use even for those beneficiaries, so that you could disperse the money to grandchildren or children based upon their tax bracket at the time. So examining not only your own tax bracket, but the brackets of your beneficiaries is going to be critical when it comes time to crunch the numbers and plot your course for your retirement plan beneficiaries and how you want that to be structured. We're going to talk about charitable goals, and I'll mention it here. There is still, under the new rules, the opportunity to contribute $100,000 per year directly from your IRA or 401k to a charity, provided you have reached the required beginning date. So the minimum RBD is now 70.5. Provided you're 70.5, you can make a $100,000 annual contribution from your retirement account directly to a charity, and it doesn't count as adjusted gross income. It passes free from the IRA to the charity. And that's a great opportunity to benefit charities during your lifetime. We also highly recommend, if you have options, to leave charities certain assets and individuals other assets, that the charities be given the retirement plan assets. And this is a simple tax switch. And we have a lot of clients that come in and say, well, I've left the charity in my will, and my will has highly appreciated real estate, stocks, bonds, etc. Well, upon death, everything passing through the will gets what's called a step up in basis, meaning that the beneficiaries inherit with a new tax cost basis equal to the fair market value on the date of death. What does that mean to them? That means that what they inherit is clear of capital gains tax. So a highly appreciated stock portfolio or real estate or a business goes to the beneficiary income tax free. And if you're under the 11.58 million free of federal estate tax and under the 5.85 free of New York estate tax, it's cash. They don't pay any tax on that inheritance. But if you leave those assets to charity and you then leave your IRA 401k to individual beneficiaries, now they're subject to the full income tax, and now even worse, they're subject to the Secure Act 10-year rule. So if we simply conceptually look at our estate plan as a whole and target anything we want to leave to charity to be left from retirement accounts, and anything going to our individual beneficiaries from all the other assets in our estate, we're going to be way ahead of the game from a tax perspective. And then finally, there are certain types of trusts we're going to talk about in a moment that allow us to name a trust as the beneficiary, where our beneficiaries, our children, can have the lifetime income, and the charity would only receive the assets upon that child's passing. So that's another way to ameliorate the 10%, or excuse me, the 10-year rule and the necessity of liquidating the IRA over 10 years. So we talked about multi-generational spray trusts, having single trust be the beneficiary, having it qualify for the 10-year rule, so you can either lump sum it in or amortize it over 10 years, perhaps having it qualify for a disabled child's exemption so that we can stretch it out over the oldest beneficiary's life expectancy, or simply having it pay into that trust and then having distributions made from the trust. We're going to talk about Roth conversions with some detail, spousal rollovers, and how to analyze whether to roll over or not and what the best option is for that plan. IRAs payable to charitable remainder trusts, state income tax issues, because New York does have a state income tax, life insurance solutions, and I already mentioned the special needs trusts. So let's take a step back. Let's look at the context and why these decisions are so important. We've talked about the statute, the exceptions to the statute, the new 10-year rule, but why does it really matter? And if you look at the tax chart here, you'll see the pyramid with 37% being the highest marginal tax rate. And when I said before that we need to know where our beneficiaries fall in terms of their tax rate, well, it's totally dependent upon their income. And you'll see on the left side, single individuals, and on the right side, married filing jointly. And if you'll notice, the numbers don't correlate. The single side is a much lower number than the married side. So we get higher exemptions for married individuals before they hit the 37% rate. You'll see it's up to $622,000. You have to get there before you get to the highest individual tax rate as a married couple. So that's pretty high. Go down the list to the other beneficiaries. You need to know where everybody falls. And this chart looks at 2020, married and single, but it also goes back to 2017. And you may ask, well, why is that relevant? Why is 2017 relevant? And the answer is 2026 will look just like 2017. Remember those tax cuts that came into play January 1st of 2018. They came in with a sunset provision. So the individual tax rates that we have today, that 37%, will be 39.6% once again in 2026. Now, could that happen sooner? Of course. We talked about the election, we talked about politics, we talked about the debt. All of those things could come into play to change the tax rates earlier than 2026. But even if nothing happens, in 2026, they go back to 39.6%, and you'll see that the brackets get pushed down. So when we're looking at our beneficiaries, this is one of the, we don't know what we don't know. You don't know at what age those beneficiaries are going to inherit. You don't know what their station will be in life, what their tax rate will be. But fundamentally, we do know this. Income tax rates are due to go up in 2026, regardless of any further legislation. And because of budget concerns, deficits, et cetera, and the debt, we believe, this is a guess, we believe that tax rates may well go up sooner and exemptions may come down sooner as the government looks at its debt and tries to reduce it. So those are things we need to keep an eye on. Can't really plan today for all of those contingencies, but know that when you're examining the beneficiary's tax rates, those rates are likely to change. So let's go to them for a minute and talk about trusts as the beneficiary of an IRA. We in our firm are big believers in trust planning. We use revocable living trusts during an individual's lifetime for a variety of things, manage assets, to avoid guardianship, to avoid probate, and to create downstream trusts for our beneficiaries that we call beneficiary control trusts. We also, if we are creating trusts for individuals, for beneficiaries, we are looking at creating things called asset protection trusts for the benefit of our beneficiaries so that in the event they do have a liability. The biggest one for parents, and I'm in this camp, I don't have children that are married yet, but I expect that they will be. I don't know who their spouses will be. So with a divorce rate north of 50%, when I leave my assets to my children, those assets will go in trust. And my children will have the opportunity and the ability to manage their own trust and benefit from it. Hence, we call it a beneficiary control trust. But their creditors, their divorcing spouses, judgment creditors, bankruptcies, Medicaid, cannot reach into that trust. That's become a very popular concept among our clients. So when we're naming that type of a trust as a beneficiary, we now have to draft in provisions that create contingent planning for those beneficiaries and have the ability to mitigate the income tax consequences, because in addition to putting our assets into our living trust, we're going to name the living trust as the beneficiary of the retirement plan assets. So with regard to that, when we're looking at structuring trusts, one of the options, as I mentioned earlier, is a multi-generational spray trust. Now, this becomes a bit unwieldy, if you will, from a management perspective, but it is something that's being recommended by the pundits. And this is a single trust with a number of beneficiaries and a trustee who would have discretion on an annual basis to distribute to those beneficiaries. And you have to know that trusts pay tax at a much higher rate, much faster than individuals. So the number for trusts to hit that highest income tax rate for a trust is $12,950. So how do we manage that? We have the trust income pass through the trust. We're going to get to that in just a minute. Let's talk for a minute about Roth conversions, because this is an opportunity to take those taxable dollars and to convert them to a tax-free account. So in a traditional IRA, you're investing money and it's growing tax deferred, but in a Roth account, you're investing money and at the end of the day, you're taking it out tax-free. The difference, of course, is that the dollars going into the traditional are income taxed. The dollars going into the Roth are after tax. So there's an opportunity to do a Roth conversion. And how does that play out with regard to the 10-year rule and the lower brackets? As I mentioned, the Roth is 100% tax exempt. There are no required minimum distributions, either at 70.5 or now at age 72. So that Roth can continue to be invested and grow on a tax deferred basis. The required minimum distributions on an inherited Roth do mirror the traditional. So for us as the participant, we don't have required distributions, but a beneficiary has to begin withdrawing the Roth on the same rules. And so is it beneficial for me to take my traditional fully taxable IRA and convert it to a Roth IRA? If it falls into any of these categories, traditional 401k, etc., we have the opportunity to convert that to a Roth. But if it's an inherited IRA, we cannot. So the beneficiary of that inherited IRA does not have Roth conversion options. So who is this for? Who should be considering a Roth conversion? Anybody with a favorable tax picture that has loss carry forwards or large charitable deductions or other things that would reduce their current year income. You can convert your Roth account or convert your traditional account. And remember that when you convert, you have full taxation on the converted dollars. So if you convert an IRA and it goes to a Roth, it's going to generate tax on that full conversion. If you have losses that can offset that, that's an excellent way to do it. If you can pay the tax with non-IRA money, one of the downsides is if you use the conversion and you convert your IRA account and you then use those same funds to pay the tax, you have such a reduction in the amount of the account that you are very likely not to recover. So if you are contemplating a Roth conversion and you don't have losses to cover the conversion, most people would not, then you want to make sure that you have outside dollars, cash or other non-IRA, non-qualified dollars to pay the tax generated by the Roth conversion. So if you expect that your tax rate is going to increase dramatically in the future, that's another reason. If you are going to owe estate tax, if there's anyone out there that has an estate tax burden, if you think about the fact that if you do a Roth conversion and you're paying the tax from other assets, now you've reduced the size of your estate and the size of the ultimate estate tax. So you're taking assets off the table from an estate tax perspective and ultimately giving income tax-free dollars to your beneficiaries. And for people who are looking at things like their capital gains rate, which can be pushed up, remember that pyramid? If you hit a certain level, you go from 15 to 20% capital gains rate. It may push your income tax up in future years. You may be worried about your Medicare premiums going up because now they're income weighted. You may be worried about Social Security benefits. If any of those are concerns, then you may want to take a look at a Roth conversion so that you don't have those required minimum distributions, which later on in the game are going to inflate your income and potentially cost you more money. Take the hit now, bite the bullet now, provided you have funds to pay the tax, and then have the Roth account available to you tax-free, but without the required minimum distributions that you would otherwise have. So let's take a sidestep and take a look at the math of the Roth conversion. So we're looking at current account balance of, again, nice easy math, $1 million. If we do the Roth conversion now, assuming we're in a 40% combined state and federal tax bracket, we're going to lose $400,000 off of that. So we have $600,000 left, and we're going to reinvest it. The growth until death at 200%, you'll see in the traditional column, we are growing up to $3 million, but then we're going to pay tax on that entire amount ultimately. So it reduces it back to the 1.8 million. On the Roth side, we've taken the hit up front. So mathematically, we're going to go back and grow back to virtually the same place. So when we look at the Roth math, we have to factor in the tax rates of the different beneficiaries, because all other things being equal, this may not be the best play for us. So what are the tax rates now? What are the tax rates going to be in the future? Making sure we have outside funds to pay the tax so that we have $1 million growing in the Roth, which is going to give us an accelerated return ultimately over time. The need for the IRA funds to meet living expenses. So that's something that has to be factored in if we're going to be pulling out more from our IRA later. And then the time horizon. So this next graph illustrates the changes in the law, and that green triangle is the ideal situation, so the sweet spot, if you will, for Roth conversions. So if you're considering converting to a Roth, you need to take into account all of these various factors, all of the variables, and your tax rate, your children's tax rate, the tax rates of other beneficiaries, whether you have funds to convert the Roth now outside of the IRA account, what your need for those funds will be during lifetime. And for a lot of people, the Roth is a very good play today to move money into an account that over time is going to grow tax-free and not just tax-deferred. So I mentioned earlier that the spousal rollover is still available, but that there are some issues that we need to address. So if you leave the spousal rollover intact and that IRA continues to grow in the spouse's name, then the spouse is going to have a very large retirement account passing to beneficiaries subject to the 10-year rule. If instead we leave some of the retirement account to those ultimate beneficiaries, or even to a trust for the spouse, which is going to pay out over his or her life expectancy and not simply be a rollover, it comes out at a different pace. Instead of rolling the entire account over, we may want to start to take some of that money out now and start to pay the income tax on it again to level out the brackets to avoid that large hit if we end up with a large inherited IRA subject to the 10-year rule. So we can look at this, and there's math. We have purchased software actually to do the calculations to quantify what these decisions look like based upon all of those variables that I mentioned earlier. And when you run the numbers, you're going to want to also involve your financial advisor, and you're going to want to involve your accountant. So to really navigate the 10-year rule and the planning under the 10-year rule, and whether or not you should do a spousal rollover, having everyone at the table is going to be to your advantage. The way that we plan for this now to make decisions later. So when you're doing your beneficiary designation, and I would ask that everyone on the line today, on the webinar today, pull out your beneficiary designations and see who the actual beneficiaries are. You may know, you may not, but verify who they are. And then think through what would be the ideal situation in my case to do this, either a Roth conversion or to do some of the other strategies that we're talking about here today. And the beneficiary designation is the key document in all of this. It's going to determine where that IRA is going to go. And spouse may be one, but we can build a disclaimer into that IRA for the spouse so that you get to back end the decision. So I name my spouse as the primary beneficiary on my beneficiary designation form. And this is something we've done for a very long time using contingency planning, which I mentioned earlier. I can then say that if my spouse disclaims all or any portion of the IRA, that portion can flow into a trust. That trust could be for the benefit of the spouse and or the family members. And that would then have some of that retirement money pulled out over the spouse's life expectancy, as opposed to the joint life table of a rollover, or it could be pulled out over a 10-year rule or a beneficiary's life expectancy if you have a qualified eligible beneficiary. So using disclaimer planning has always been a good idea, but with the Secure Act, having the ability to tailor the plan post-death of the participant is absolutely critical. So disclaimers are something that we're using a lot of in doing the planning. I mentioned earlier charitable trusts. I'm going to do this very quickly because a charitable trust is a complex tool. We use them for a variety of purposes, but you'll see in the diagram that you can put assets into a charitable trust. And a lot of people create trusts during lifetime, fund them, keep the income for themselves, and then when they die, the balance goes to charity. The difference here is we create a dry trust. So you have a charitable trust waiting as a receptacle for IRA benefits. Because it's a charitable trust, it is tax exempt. So that $1 million IRA that we were talking about earlier, subject to the 10-year rule or subject to a lump sum distribution, that $1 million comes tax deferred into the trust. It then gets reinvested. So when the participant dies, the trust gets funded, $1 million is reinvested, and now the child gets an income from that charitable trust for life or for a period of years, and that would be something that will, again, reinvigorate the stretch. And I have a chart here to show the end result that I'm going to flip to. And this slide shows what happens if you have a 10-year rule. The green one, which looks very, very favorable, is great, but it's old law. That's the life expectancy table. So if you have an eligible beneficiary, that's going to be your result in this scenario. After 35 years, what's left and what has the family received? But the box all the way on the right is 10-year rule with a charitable remainder trust. And you'll see that it, compared to the other rules, not the old rules, but any of the new scenarios, the charitable trust actually produces a more significant stream of income over the life of the beneficiary than simply taking the money and reinvesting. So a charitable trust and that continued tax deferral using a charitable deduction is something that we can do. And this slide illustrates the benefit not only to the family, but ultimately also the benefit to a charity. And here you'll see that the charitable trusts outperform the other options by far when it comes to creating total wealth for your family and for your favorite charity. I mentioned that New York taxes income as well, as we all know who live in New York, one of the major income tax states in addition to California and some of our other northeastern colleagues here. But New York taxes at a rate of 8.82%. So when you're doing your math, you have to look not only at federal brackets, but at New York State income tax brackets as well. And at the top rate, we have an 8.82% tax that we're going to have to navigate. Can we eliminate that or avoid that? And is there a way to have a trust be the beneficiary and pay only federal tax? And the answer is yes, but not in New York. So we are versant. We do a lot of trusts in other states, Delaware, Nevada, etc. So you can create a trust to be the beneficiary of your retirement account under, for example, Nevada law. And you can opt in even though you're not part of Nevada, you're a New York resident. You can opt into Nevada law, have your IRA paid to a Nevada trust, and have that Nevada trust be the beneficiary, paying only federal income tax and avoiding the New York state income tax. Now, remember, you have to look at not only yourself, but your beneficiary. If your beneficiary lives in Florida, Florida doesn't have any income tax either. So you need to examine the state law of the beneficiaries of your retirement account. And that's going to determine whether you should consider some type of trust that would have the ability to avoid state income tax on behalf of the beneficiaries of the IRA. So life insurance has become a topic based upon the current Secure Act rules that is very much in play. And life insurance can fit into a plan in many different ways, but with regard to your IRA, we basically have two scenarios that I want to illustrate where life insurance can be used. Number one as a hedge, number two as a full planning vehicle. So in a Roth conversion strategy, we may use life insurance, but also in what we call a relocation. So taking the dollars from your IRA and relocating them into an insurance policy. So with the Roth hedge, when we do a Roth conversion, we're banking on the fact that our asset base, wherever we pull the dollars from to pay for the tax on the Roth conversion, that our asset base is going to grow back over time. But that's over time. Is there a way that we can cover the gap from the day we do the Roth conversion to the point in time where we hit that crossover, where we've grown back enough assets to make up for that differential? And the answer is yes, we hedge it with life insurance. And here it's a time horizon hedge. So we could do a 20-year or 30-year level term policy, have that term insurance in place, and have coverage so that our estate would be grossed up. We would have the full amount of assets in the estate, part of it coming from life insurance dollars to replace the dollars paid in income tax on the Roth conversion. So that's hedge number one. The relocation is a bit more broad and powerful, and that is taking dollars out of your IRA early, putting them into an account that is in a life insurance policy, and having the ability to have that life insurance policy then grow, again, tax deferred. And this is typically using life insurance that is whole life or variable life. So you would be taking investment dollars out of an IRA, paying tax now, if it makes sense, on lower tax brackets, if that's you, pulling the money out, relocating it over to a life insurance policy. And for whole life, that policy can grow. It grows on a tax deferred basis. When you want to take money out of the whole life policy, you pull it out on a borrowing basis. You take a loan from yourself, in fact, from the life insurance policy, and you don't pay income tax. Upon death, the death benefit covers the loan plus pays to your beneficiaries an enhanced amount based upon the death benefit. So whole life, variable life, one play. Another play, and this is something that we kind of combine with our long-term care planning, because a lot of policies now that are covering long-term care are traditional life insurance policies with a rider. So if you're contemplating getting some type of long-term care coverage, you can look at pulling dollars from your retirement account early, taking those dollars, paying the tax at your rate, taking it out in small amounts over time, taking the net dollars and buying a life insurance policy that would create a death benefit that over time will simulate the amount of money that you would be withdrawing early from the IRA. On that policy, you can put a rider that would allow you to access the coverage to pay your own long-term care costs so that you don't have to pay them out of your other resources. So life insurance, long-term care rider is another strategy, pulling dollars out early, paying some tax now, looking at the brackets, paying at our lower rates during our lifetime, and then having tax-free dollars passed to the beneficiaries upon death. So what about our next generation? I talked about these beneficiary control trusts, and it's something every parent should think about. How do we want our children to inherit money? With the Secure Act, we have tax dollars overlaid on the traditional concepts, but it's possible to create an asset protection trust for our children right within our own revocable trust or irrevocable trust, and have that trust be created seamlessly upon our death. We can then direct the retirement plan funds to that trust. We've built language in, and the way that we're dealing with these types of future trust contingencies now is we use something called a trust protector. So if you want to name a trust as your beneficiary, and if you want to protect those assets for your children's benefit, then we're going to want to have those trusts fully protected from an asset protection standpoint, but with enough flexibility that the income tax consequences of the Secure Act don't cause unnecessary tax consequences. So with a trust protector, we have the full opportunity to draft provisions in and have someone in the trust document with the power to tailor the benefits. Remember our accumulation trust, the disaster of the accumulation trust? If all of that money flows all the way through to the beneficiaries, we lose the benefit of this asset protection. If we have the ability to toggle and say, okay, we have an accumulation trust, but if the beneficiary is in a situation where accumulating the money inside is going to be more favorable, and we have then an opportunity to do further tax planning with that distribution and the 65-day rule at the end of the year, then our trust protector can actually amend the document post-death. So we can toggle an accumulation trust, a conduit trust to an accumulation trust. And we can give the trust protector the ability in the document to deal with all those things that we don't know. And trust protectors have been something that we've been using in our more sophisticated trusts for a very, very long time. Comes to us from hundreds of years of tradition offshore, been onshore for about 20 years. And we've been using them in those trusts, but now we're using them in most of our trusts. So having the ability to have a trust protector who can in fact come in, intervene later when we know what those regulations are, when we know what tax rates are, and tailor the plan to your own particular situation is the best drafting we can offer. So with our new trusts, we're using this trust protector language. And so looking at what now, what are your next steps with regard to your particular retirement account? You need to get a good consultation, and we recommend that you involve your team. If you're a client of our office already, we have a program where we try to bring the three professionals in your financial picture together: your accountant, your financial advisor, and your attorney. And that's our PALM system, which is a lifetime maintenance system. So we are meeting with all of our PALMS clients throughout the year, and we will be going over their trusts and recommending any necessary changes to those trusts. If you're not in our annual PALMS program, then we would recommend that you schedule a consultation. We'd be happy to look at your current trust language, look at any recommended changes, and then discuss with your other advisors what the best path forward would be. Remember, you have tax rates, your own, your beneficiaries, that have to be factored in, along with all of the other variables of tax law and tax planning. Having a good team working with you on that is absolutely the way to do it. So with that, we have questions.
Yes, so we are continuing the webinar for a little bit longer to ask some questions, so please feel free to stay on if you'd like to get some answers on these. Our first question is, at what point should I be meeting with you or my financial advisor about the effect of the Secure Act? Is it something that will impact my tax returns this April?
Okay, so it's important to remember that the Secure Act has several components. Depends on your age, how much it impacts you. If you are in that zone of 70 to 72, then you have critical decisions to make as to whether you begin your required distributions, whether you defer to age 72. So those are things that you want to be talking to your team about now. The rest of it, with regard to designating beneficiaries, it's not going to impact you currently, but it will impact you in terms of beneficiaries. So we want our clients to get their documents reviewed and get their language updated, because as the last slide says, life happens, which is our radio show, which we invite you all to listen to every Saturday morning at 11 a.m. on WGY, but not knowing what's going to happen tomorrow, let alone next year or in 10 years. Having your documents updated quickly is important, but it will not impact, from the beneficiary perspective, your current income tax situation. Whether there is any part of the Secure Act that will depends upon whether you have those decisions to make in the 70 to 72 age range, whether you want to contribute continually, or if you're considering a Roth conversion, that wouldn't impact last year, but certainly that would impact 2020. So April 15th is not going to be a critical date for a Roth conversion for this year or beneficiary designations, but it may be for some of the other rules that are impacting people with this new law. Sarah?
And our last question is, do I have to have a trust to be concerned about the Secure Act, or just IRA accounts?
Just IRA accounts. Trusts offer solutions, but any individual beneficiary who's going to receive your account is now subject to the 10-year rule. So a traditional individual married couple would say, I leave it all to my spouse if my spouse predeceases to my children. The spouse would have the opportunity to roll it over, and the kids would be subject to the 10-year rule unless they have a disability or at the time are chronically ill. So we believe that trusts offer solutions for your beneficiaries, and if you want to take advantage of those solutions, then the Secure Act has to be factored in to how that trust gets drafted. But you do not have to have a trust to be impacted by the Secure Act. It's hitting everyone, regardless of trust or individual beneficiaries. Okay, and I think that's it for the webinar. I want to thank you all for joining us this morning. Hopefully you found it valuable. If you have any other questions, you can email them to us and we'd be happy to answer them. And you can email info@pirolaw.com. Again, info@pirolaw.com. And if, as always, you'd like to schedule a consultation, just give us a call and we'd be happy to set you up. Thank you. Have a great day.